Welcome to Mad Money. Welcome to Cramer. Two big friends. I'm just trying to make you a little money. My job is not just to entertain, but to put it in context. So call me 1-800-743-CNBC. Tweet me at Jim Cramer. Bulls waste a huge amount of time shadowboxing the Bears. Yeah, the Bulls are always on the defensive, even when they have the history, the data, and the numbers on their side. How is that possible? I think people just refuse to trust the market. They want to find reasons not to like stocks, and they're willing to go to great lengths to find them. Sell. You can see it on a day like today, one that started very negative and then rebounded slowly. Dow ultimately finishing up 144 points, S&P advancing 0.58%, and then Nasdaq climbing 0.89%. Wow, that was terrific. Now, I spend a huge amount of time in how to make money in any market talking about how you need to trust the stock market. You need to believe in it to invest. If you don't, you'll constantly get scared away at exactly the wrong time. Habitually buy high and then selling low. And that's, I think, why so few people actually build wealth in the stock market. So let's talk about the doubts that drive people away from being good investors using today as a reference point. You know what I want to do? I'm going to tick down the objections raised by intelligent people that make you feel like a chump for owning individual stocks. And they do, particularly rich people, by the way. Let's go through the steeplechase of October, right up until this morning. First, we're on day 23 of a government shutdown. Go back to the beginning of the month. What was the rhetoric of the moment? It was simple. While shutdowns historically haven't meant anything to the stock market, we were told this time, would somehow be different. Why? Because of President Trump. Meaning that because of President Trump, the shutdown would be bad for stocks. What happened? Well, the market's been fine. It hasn't been hurt by a lack of economic data. It hasn't been crushed by what could happen if hundreds of thousands of federal workers stay furloughed. Unless you work for the government, you might not even know what's going on. That may be unfair, but it's true. Again, historically, these shutdowns simply don't matter to the market. If anything, they've been a positive catalyst for stock as crazy as that seems. The one problem is we haven't been getting a lot of government data. Tomorrow, we're going to get the CPI, the Consumer Price Index. Now, interest rates went up today, I think, in preparation for a bad CPI tomorrow. If it indeed is too hot, there'll be another set of people who are going to come on our air, and they're going to tell you to sell because of the CPI. Do me a favor. Don't listen to them. Second, hardly a day goes by when the president doesn't threaten or cajole or express frustration with China. Every time he says something, it's front page. It's almost always negative. I mean, people shake. The media makes it sound like it's heightened tensions with China, economic catastrophe. There's a whole host of hedge fund managers eager to tell you this is a perilous time. They're so rich, they don't care about you. They don't. Semis get sold off, even though some are in short supply like Micron or Intel, which reported a fantastic quarter this evening. Those stocks get sold all the time because of China. Look, I don't mean to mock the process of foreign relations, but this is a president who negotiates in many different ways. Usually he takes a hard line that freaks people out and causes them to sell stocks. Sell. But then he compromises and you feel like an idiot for bailing on the market, and now you don't get back in, and there goes all the money that you were hoping to make in the stocks. I've gotten to the point where when I see the market come down because of the president's statements about China, I want to tell you just to go buy because it's been a winning strategy the whole way. Third, 9 days ago, we heard the most distinguished banker in the world tell us that we were entering a period of heightened risk where mistakes can and will happen. There have been two big defaults, one of them causing J.P. Morgan to take a $170 million charge. CEO Jamie Dimon said at the time, quote, "I shouldn't say this, but when you see one cockroach, there's probably more. Everyone should be forewarned on this one," end quote. At the same time, there were some other bad loans in the system that dinged a couple of regional banks. It caused a huge firestorm of selling. The regionals, they got crushed. But it turns out there is no cockroach infestation. Looking at the banks that have reported, we're actually seeing some of the fewest defaults as a percentage of loans I can ever recall. Bank of America, Wells Fargo took pains to point that out. So did American Express. Capital One. Look, I'm not trying to give Jamie Dimon a hard time. Let others do that. He's an amazing banker. He's a nice guy. I think it always pays to be vigilant. He's probably right that there'll be eventually other cockroaches. There's always a lot of cockroaches. It's like, you can't. Nuclear war's not going to take those guys away. But so far, the rest of the industry looks pretty clean. You know what? I've been thinking. I think, Jamie, it was an ill-advised analogy. Here's what I would say would have been better. Sometimes you just get had. Fourth, we know one thing when we came into this month. Apple stock had become suspect, scary, dangerous. I mean, like, wow. Sell, sell, sell. So many experts told us that the iPhone 17 wasn't doing that well. We heard about weak lead times and how this one was just one more iteration in a tired and boring line of phones that nobody really wanted. An analyst from Jefferies on October 3rd downgraded Apple from not from a buy to a hold, no, but from a hold to an actual sell, a sell. Saying that anything good about the new phone was already priced in, the expectations were excessive. This downgrade sent chills through any Apple bull. In other words, he was saying even if the numbers were good, it wouldn't matter. I bet that scared a lot of you. Did it scare you? Did you sell the stock because of it? Did you violate my own Apple don't trade it dictum? This week, we started with 3 different firms proclaiming that the iPhone 17 turned out as much bigger hit than anyone thought. Gettable fact. Just had to look at the lines worldwide to see how people were desperate to get their hands in this thing. You just had to listen to the outgoing CEO of T-Mobile when he told you the sales were brisk because of the deal they were offering the 17. Honestly, you just had to try one to see how special it is. Yeah, Apple keeps going higher. Finally, the tariffs. We've had a couple of weeks of earnings season. So far, the tariffs really haven't been that much of a factor, other than the media where we ask everybody about them. I've yet to see a downgrade triggered by the tariffs. It's not that they aren't there. It's just they're not smoot holy. If they got baked into share prices months ago, well, you won't even notice. If you sold because of the tariffs, and so many of you did, well, we apologize. Shouldn't have scared you. You need to remember that when the CPI comes out tomorrow, because just in case it's too hot because of the tariffs, you don't sell stocks by mistake. Outside of here, right over here, is a street, okay? It's called Broad Street. 42 years ago, I walked down this street on the way to my job on 55 Broad at Goldman Sachs. The Dow at the time was at 1,000. That was some 45,000 points ago. Do you know what I heard every day back then when I was at 55 Broad Street? I'll tell you what I heard. Oh, what a terrible time to invest. Horrible. Rates are too high. Housing's too expensive. Inflation's still out of control. We had a cowboy actor as a president who didn't know anything about the stock market, and even his own vice president accused him of practicing voodoo economics. So when I started working, I heard the fabled 3 words that I've heard for most of my working life, including from my own lips when I got it wrong, and that is, get out now. Since then, since I first heard get out now, the Dow Jones Industrial Average is going from 1,000 to about 46,000. To many of the people who come on and talk about the market, that rise means absolutely nothing. They treat the market as if we're a coin with a bull on one side and a bear on the other. Doesn't matter that there's history on the bull side. They treat each session as a 50-50 coin flip. But the bottom line, this market is not a bunch of coins to be flipped. It's a collection of companies to be invested in. So do this for me. If you're going to think of the market as a tug-of-war between the bulls and the bears, would you at least think of the bulls as the favorite and give them the benefit of the doubt? Because if history's any guide, the bull deserves it. Gregory in California. Gregory.
This is Gregory, and I've got a problem. I'm an overbuyer. Jim, I own too many stocks. I own more than the investing club. I may need you to be my sponsor and help me out here because I find it hard to sell quality. So, look, if you tell me to get rid of this one, I will. But it beat the street's EPS by a whopping 1,000% over the last 2 quarters. And the price went from 120 to 283 as a result. Now, it's come way down, but I still have a pretty sizable gain. So do I sell it now, hold through earnings that are in a week, or buy more of Reddit?
I think Reddit's doing terrifically, Gregory. Thank you always for your call. You're just an amazing follower of Mad Money. I think Reddit's going to go much, much higher. They've got the data that a lot of these search engines need. And I've got to tell you, I think Steve Huffman is he's really he doesn't get the credit he deserves. I like the guy. Let's go to Dan in New York. Dan.
Hey, Jim, calling you from Oyster Bay, Long Island. Love your show, all your insights.
I love Oyster Bay. I love Oyster Bay. Some of my guys like to play at Piping Rock, but that's because they're America's guests. I don't get into any of those clubs. What's going on?
It's a great course. Well, the stock I'd like to talk about is UPS. I bought this stock as a value play earlier this year when it was getting beat up. Couldn't resist the yield and continued to get beaten up with the tariff news, and I bought some more. and the price has stabilized around 85-ish. So I'm averaged in about 103. And my questions are: should I buy more? Should I hold? Or
I think the stock's trying to bottom. I think the stock's trying to bottom, Dan. I personally don't care for it. I am a huge buyer of FedEx, and I like JB Hunt. So don't say I'm anti-transport. That would be a big mistake. It's just that I do feel that UPS, the dividend's so big. I don't know, and I know they're sacrosanct, but they could use some money. All right, if you think the market is just a constant battle between the bulls and the bears, at least could you look, I'll tell you, got to give the points to the bulls because I got to tell you, they just do better than the bears, if history's any guide, okay? They're the favorite. How about that? Well, Mad Money tonight. Breaking up is hard to do unless you're General Electric. I'm running through the earnings reports from two of its descendants, GE Aerospace and GE Vernova, sharing you where I come down on these two excellent companies. Then what the heck happened to the stock of IBM early this morning? I'm going to break down the post-earnings move with Big Blue to help you make sense of where the company is headed next. And Dover hasn't caught fire this year like other companies with the ties to the data center. But today's move, I don't know, maybe a sign of things to come. Let's sit down with the company's CEO to find out in this terrific investing club holding. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
The market doesn't always get things right, especially during the heat of earnings season when there's simply too much information for anyone to process all at once. Just look at two of the children of General Electric, GE Aerospace and GE Vernova, two of the best performing stocks of the year, up more than 80% apiece. Both companies reported terrific quarters, but both of their stocks initially sold off before rebounding dramatically from their lows. I want to walk you through what's going on here because these two represent very important parts of both the real economy and, yes, the data center economy. Why don't we start with GE Aerospace, which makes jet engines along with all sorts of other airplane components with a huge maintenance and repair business that's incredibly lucrative. When GE Aerospace reported on Tuesday morning, they delivered a clean top and bottom line beat, stunning 26% organic revenue growth. That growth was driven by better than expected results in both their commercial engines and services divisions, as well as their defense and propulsion technologies business. In fact, management was so confident in these results that they raised their full year forecast pretty much across the board. To me, this was an amazingly impressive quarter. I read it in the morning. I said, around about 6 o'clock, I said, look at this thing. This thing's going to go nuts. But Wall Street had a more mixed reaction than I did. After rallying a little less than $4 on Tuesday, the stock then gave up all that and more yesterday before rebounding $8.50 today. So which was the right move, the rally on Tuesday and today, or the decline yesterday? While there were some concerns about GE Aerospace's implicit guidance for the fourth quarter, I think that's mainly management being conservative. On the other hand, there are a ton of positives here. In fact, I could argue that this company, stewarded by Larry Culp, who's such a great executive, may be the best industrial report this year. For starters, the company's commercial engines and services business, by far their largest segment, put up some tremendous numbers. 22% growth in equipment revenue, while the services revenue shot up 28%. That was aided by a 33% increase in internal shop visit revenue. Keep in mind, GE Aerospace really cleans up with their services business because it carries much higher margins than selling equipment. That's how the commercial engines and services division grew earnings by 35%. I love a good maintenance business. I don't even care if you give away the darn engines. If you get that maintenance business, you can make a lot of money. Management now expects to see commercial engines and services revenue growth in the low 20s for the full year. Previously, they were guiding for a growth rate in the high teens. That's a real uptick. At the same time, GE Aerospace had lots of positive things to say about their supply chain, something that requires a lot of attention in this age of much higher tariffs. The company's seeing its priority suppliers, the ones that are mission critical, continue to improve on their shipment targets. These suppliers shipped more than 95% of committed volumes for the third consecutive quarter. Very impressive figure and a huge improvement over a year ago. I think some of that was because of COVID. It's the hangover of COVID, very much underestimated. Now, you might be asking, how much can these supply chain improvements really matter? But management credited these improvements for the record leading edge aviation propulsion, or LEAP, deliveries they saw last quarter, up 40% year over year. LEAP is a family of turbofan jet engines, one of the company's most important commercial products. GE Aerospace expects LEAP to become the industry's most utilized narrow-body engine. People love those narrow bodies in the not-too-distant future, eventually surpassing the CFM56. That's made by a joint venture between GE and the French company Safran Aircraft Engines. But the real key here is not engine sales. Again, it's the engine sales create a large installed base that requires high-margin maintenance services. Because GE Aerospace can now reliably get their hands on their most important inputs, they'll be able to increase LEAP engine deliveries by more than 20% for the year, when previously they forecasted just something between 15 and 20%. That's major. In the end, both GE Aerospace and GE Vernova are poised to be winners from the president's trade war. Because when other countries decide to make nice with Trump by narrowing their trade deficits with us, they need to buy lots of big-ticket items to really move the needle. That means they need to buy aircraft. They need to buy turbines. Just this past quarter, for instance, Korean Air agreed to buy 103 aircraft from Boeing, many of which will contain engines from GE Aerospace. I think this is one of the best ways to play the incredibly robust bull market in aerospace and travel. Plus, it doesn't hurt that even with today's rally, the stock's only a few bucks higher than where it was trading before the latest quarter. You're practically getting this terrific quarter for free. All right, now how about GE Vernova, which we own for the Travel Trust? Once again, GE's old power business reported an excellent top and bottom line beat, spectacular organic revenue growth, rising margins. Most importantly, GE Vernova saw its backlog grow 15% year over year, up to more than $135 billion. The company racked up almost $15 billion in new orders. Remember, orders give you a direct read to the current level of demand for the company's products. Despite these numbers, though, GE Vernova's stock initially plunged 9% yesterday, before rebounding from its lows and finishing the session down 1.6%. Today, Wall Street reassessed again, and this stock shot up 3.3%. Now, that move makes sense to me. As I told you last night, GE Vernova reported a terrific quarter, and the stock only sold off because it had already run up dramatically going into the earnings because it's connected to the data center, and people love the data center because you need their engine, electricity, for the data center. As we told CNBC Investing Club members, there was just a lot to like here. Management gave us a ton of positive commentary about their $5.3 billion purchase of the remaining 50% of Prolec. That's their joint venture with the Mexican company makes equipment for the electric grid. GE Vernova's buying the entire thing. As CEO Scott Strazik sees it, this acquisition will bulk up the company's exposure to their fastest-growing segment of their power business, which is electrification. Remember, the grid is old-fashioned and can't grow the way it should without their equipment. It is hard to argue with that statement, as Prolec's largest product offering is power transformers, the kind that are used in the data center, alongside all sorts of other energy-intensive applications. At the same time, management says they're seeing significant investment in electrification to the point where GE Vernova expects their combined serviceable, addressable market to expand at a 10% compound annual growth rate, eventually doubling in size by 2030. Yeah, that's a data center because this business had almost no growth for years and years and years. What else? This is a moment where there's a ton of speculative interest in nuclear power. I think too much, by the way. Those speculative stocks have been obliterated in recent weeks. GE Vernova actually builds nuclear plants. Make this one of the safest ways to play the theme, even if it's going to take a long time before any of this plays out, simply because building a new nuclear power plant can take more than a decade. But I think we're going to begin to hear a lot more about what's known as small modular nuclear reactors in the next 2 years. And that will make people realize if you want to invest in the concept of nuclear power, well, then go buy the stock of GE Vernova. Plus, while the company's repurchased $2.2 billion worth of its own stock so far this year, they say they'll continue to buy back stocks on an opportunistic basis as they believe in, quote, there is incremental value embedded in our stock. Well, it doesn't really get that much more bullish, does it? Here's the bottom line. When two of the children of General Electric reported this week, the market got them both wrong. But today they came roaring back. I'm betting that GE Aerospace and GE Vernova are ready to run, and that today's rallies were the ones that matter. Mad Money's back after the break.
Coming up, Big Blue beats again. So why is Wall Street bailing? Cramer's revealing what investors are missing when it comes to IBM's results. Next.
What the heck just happened to the crazy stock of IBM? Now, I've been a big fan of this company for the past couple of years, in large part because they figured out how to make money from artificial intelligence. IBM sells lower-cost AI models that offer tools that help developers make AI applications. And their consulting business tells clients how to use AI. That's why the company was able to return to real revenue growth for the first time in ages. It's why the stock's up nearly 30% year to date. And it's more than doubled over the past 2 years. IBM gives you all the benefits of AI, but it has a reasonable valuation and even a solid 2.4% dividend yield. But as of today, we've now seen 2 consecutive quarters where the stock sold off in response to better than expected numbers. When they reported 3 months ago, the stock plunged 7.6% in a single session and kept drifting lower for the better part of a month. Eventually, though, IBM came roaring back. Then the same thing happened just today. Last night, IBM reported what looked like a pretty darn good quarter, yet the stock opened down almost 8%. And though it rebounded hard from those levels, it still finished the session off almost 1%. So you got to ask yourself, what the heck is going on here? Now, I was surprised by this one because there was really, to me, there was really nothing wrong with the quarter. As I said this squawk on the street this morning when I pounded the table for you to buy. There was no reason for it to be down so much. IBM delivered a healthy top and bottom line beat, revenue up 9%, making this their second straight quarter of accelerating revenue growth. Their operating margin came in at 18.6%. Wall Street was only looking for 17.1%, which is how the company earned $2.65 per share. That's up 15%. Wall Street was only looking for $2.45. Arvind Krishna, CEO, he just delivered. Even better, IBM raised its full-year forecast, kind of, I'd say. Management now says they expect constant currency revenue growth of, quote, more than 5%, end quote, after previously guiding for revenue growth of at least 5%. All right, splitting hairs, but it's something. IBM also ticked up its full-year free cash flow outlook from more than $13.5 billion to about $14 billion. That's real money. Now, if you listen to the conference call like I did, at least initially, you wouldn't have found all that much to complain about. CEO Krishna began the call by noting that IBM's 7% constant currency revenue growth rate was the highest growth rate in several years, and saying that all the company's segments accelerated versus the previous quarter. He also told us that the company is seeing broad-based demand from clients. As I see it, Christian told a good story about how IBM is winning with a strategy focused on hybrid cloud and artificial intelligence. He touted strength in the software business, IBM's largest segment, where constant currency revenue growth accelerated to 9%, led by the automation software business, which was up 22% in constant currency. In their consulting business, revenue growth accelerated again, turning positive for the first time in 4 quarters, which Christian said reflects, quote, growing demand for AI services as clients need help designing, deploying, and governing AI at scale, end quote. Of course they do. We know this. And in infrastructure, the final main operating segment, revenue growth accelerated to 15%, with the success driven by IBM's new mainframe product, which launched this spring. It's always a boom when that happens. According to Krishna, it had, quote, the strongest 2-quarter launch in history. So much good here. In short, each of IBM's major segments are doing well, with AI helping to drive accelerating revenue growth across every part of the business. So what the heck happened here? Why did the sellers dump the stock at the opening? What were they thinking? When I looked around, the bears were primarily griping about some slightly softer than expected numbers from their Red Hat division. That's their hybrid cloud business, which everybody does love. And it only put up 12% revenue growth on a constant currency basis. Now, Wall Street was looking for 14%. That is a downtick. On the conference call last night, CFO Jim Cramer said that the Red Hat result was due to a, quote, softening in consumption-based services and Red Hat Enterprise Linux trending back towards single-digit growth as we wrap on last year's exceptional double-digit performance. I didn't like that. On top of that, IBM has been guiding for mid-teens revenue growth from Red Hat this year, and last night they said, quote, we continue to expect mid-teens growth for Red Hat, albeit at the low end. Long story short, Red Hat came in a little light, but it was the only key, it really is the only key part of IBM that was disappointing. Personally, I think the negative reaction to that specific piece of hair on the quarter was downright ridiculous. Even as I know that the Red Hat division, again, is loved for its consistent high growth. I loved it. I remember when they bought Red Hat, we had it on the show. We had Red Hat on the show constantly. I liked that business so bad, so much. This tick down in growth was just one detail, though, within an otherwise very positive set of numbers. Take that guidance for Red Hat, for example. IBM saying that it would now be at the low end of mid-teens growth this year. Well, how about this? Immediately after Kavanaugh uttered those words, he said, quote, as we wrap on elevated growth in consumption-based services last year, we expect double-digit revenue growth in the 4th quarter with an accelerated growth profile heading into 2026. Basically, part of the Red Hat charges on a consumption basis, and consumption was very high toward the end of last year, so they were going up against tough compares. Red Hat's currently lapping that period of elevated consumption, so its year-over-year growth looks lower. But starting next year, they expect this business to accelerate as the comparisons get easier. I don't see a problem here. Of course, you need to trust IBM's management a bit here, as I do. Specifically, you need to trust that the hybrid cloud business will truly reaccelerate, which I do. But when I look at what IBM's done these past couple of years under Arvind Krishna, I got to wonder, why wouldn't anyone trust him? I mean, the guy's totally bankable. These sellers don't believe in giving anyone the benefit of the doubt, and it's costing them money, not you. Plus, there's so much good news happening all throughout the rest of the organization. I think it's very short-sighted to focus on an ever so slight tick down from Red Hat. That includes IBM's recent acquisition of HashiCorp, another hybrid cloud infrastructure play, and that's doing great. Their consulting business has returned to growth, becoming the glue that holds IBM's AI narrative together. Even their sleepy infrastructure division is doing great with that new mainframe product that's on fire. Somehow this boring business has the fastest growth in the entire company right now. Oh, and let's not forget, they have the only commercially viable quantum computing business. You want quantum? Buy IBM. Don't buy the perpetual money losers that want government money to make up for their losses and yours. No wonder IBM stock rebounded from its lows, finishing the session off just under 1%. So here's the bottom line, a story that I think is very easy to get your arms around. If you saw IBM stock selling off this morning in response to earnings and freaked out, there's nothing to be afraid of because the actual numbers were superb. Thankfully, the market eventually came around to my point of view, but IBM is still down versus where it was before the quarter. I honestly think that the stock remains a steal here at just over 23 times next year's earnings estimates in a very overcrowded, expensive group of tech stocks. I want to go to Tom in Florida, please. Tom.
Hi, Jim. First-time caller, long-time viewer. My wife, Tina, and I wanted to thank you for the advice you've given us to own individual stocks, which has grown our portfolio and is enabling us to live the retirement dream.
Thank you. Thank you. That's what I talk about in my book that one of the CEOs just finished reading and said that's exactly the kind of stuff that he's getting out of it. So thank you very much.
You're quite welcome. Over the last year, the stock I'm calling about has had a steep climb. Should we buy, sell, or hold Palantir?
I think you can still own Palantir. It's one of the speculative stocks that I truly like. Why? Because it's actually profitable. Most of the speculative stocks I hear about are not profitable. I spend a lot of time in how to make money in any market saying, you want a spec stock? Go buy the stock of Palantir. And by the way, it's not like I'm like, necessarily buddies with the company, but I do think that they're for real. All right, look, and thanks for the kind words. Look, the sell-off this morning in IBM was overblown. I still think the stock is a steal right here at these levels, even though it recovered a lot from the decline. Now, much more Mad Money, including my sit-down with the top brass and Dover. Wow, the industrial conglomerate powered higher today after some upbeat guidance. I'm finding out there's more gains ahead on this club name. Then the bears will continue to focus on the negatives when it comes to Tesla. Maybe they're missing the big picture here. I'll tell you where I stand on the company, and I got to tell you, it's different from the sellers. Of course, all your calls rapid fire in tonight's edition of the Lightning Round coming up, so stay with Cramer. This morning, we got a very good quarter from Dover. The classic diversified industrial manufacturers made a big pivot toward the data center, aerospace, clean energy. Stock shot up more than 8% today. Good news for me, it's a big charitable trust holding. Now, technically, some people will call it a mixed to positive quarter. Dover's total revenue and its organic sales growth both fell a tad shy of expectations, but they also delivered an 11-cent earnings beat off a $2.51 basis. Management raised their full-year earnings forecast. Remember, Dover's the kind of real economy stock that hasn't done as much this year as I would like, but that's because, well, you don't need to report a picture-perfect quarter for the stock to rally like crazy, given the stock was ready to go. Could this be the beginning of a longer-term move higher? Let's check in with Rich Tobin. He's the chairman, president, and CEO of Dover Corporation. Mr. Tobin, congrats on the quarter. Welcome back to Mad Money.
Hi, Jim. Good to see you.
Which I got to tell you, I never understood why the stock fell where it did, and that's not your job to predict the stock, but it is your job to predict margins. And you are saying you don't think anything. You're looking for growth in all of your different businesses in next year.
Yeah, that's correct. I mean, we do a pretty fulsome strategic planning process in the September timeframe, where we go through business by business and take a look at new product launches, competitive stacks, and the like. And in this year is a unique one where I think over the last 3 years, we've had a counter-cyclical headwind in maybe one or two of our businesses, just because cycle on, cycle off. In this particular one, we don't see it.
Well, that's terrific, because I know I've been worried about some of the businesses, but I'll tell you what I've not been worried about, Sikora, this electrical infrastructure business, which is the kind of thing I'm looking for Dover, because I want to invest in a company like that, and that's what you do as the steward of your capital at Dover.
Yeah, look, I mean, part of our business model clearly is M&A. As you know, we went through a period where valuations are a bit stretched coming out of COVID with very low interest rates. Then we've had pretty much a paucity of assets. I mean, I think if you look at M&A and global investment banking, the numbers would show that it's up quite a bit. The middle market, not so much. So we've been kicking the can on a variety of assets. That one, I would say, is a semi-proprietary deal. We had already been working with that company in terms of incorporated or inspection technology. When we learned about it, we just said, hey, wait a minute, this is something we want to own.
All right, so Rich, what do we do with companies like a company that does refrigerated cases or a company in the canning business, historically businesses that might have grown more than they do now? I mean, some people would argue that refrigerators are actually in some sort of secular decline because we don't build as many places that might need them. Do you look at these businesses as businesses that are, don't worry, they have their own cycles and the cycles can come back?
We both the cycle of the business itself and then the competitive stack. For the most part, we participate in relatively small TAM markets with very concentrated customer bases. So even on the replacement cycle alone, when you talk about like retail refrigerating equipment, that's probably got somewhere between a 5 to 7 year life. So the entire footprint of these retail stores gets replaced over that period of time. So as you know, what we try to avoid is markets where there's too many suppliers for a limited low growth market, and then you can get in a little bit of trouble. But by and large, when we look at the competitive stacks of where we participate, even in something as basic as retail refrigeration, we like our position.
Okay, now I don't want to repeat something that was asked directly by Steve Tusa, a very good analyst, J.P. Morgan, but when you saw your stock at 160, we were pretty aggressive buyers for the trust. And the reason why we were, and we were hoping you were too, but is we said this is absurd. There isn't anything about Dover that would merit this decline. But you bought some, that you have a lot of cash left, so I must believe that you see many things that are more attractive than your stock. I couldn't find anything more attractive, but you may think there are things more attractive.
I think as we went through the year, the funnel in terms of possible M&A was quite fulsome at the time. A lot of things dropped off. Either the asset didn't come to market or we stepped away for a variety of different reasons, and we were preserving that capital. I think that we've been open and honest and said, look, we're not going to sit on a ton of liquidity. As you know, we divested some businesses last year, so we're very liquid right now. My expectation is based on the share price, even after today's rally, we still think it's cheap. So I would expect that we'll intervene on the stock price.
Excellent. Now, last time you were on was around Liberation Day. And that was, I spent way too much of our interview talking about tariffs because everybody was talking about tariffs. It looks like it's been a bit of a cost of doing business, but no more than that. I didn't see any of your businesses really slugged by it.
We discussed this before. I mean, we're very much a proximity manufacturer, so not the supply chains are not global in nature. I mean, we're not immune to it. And again, I think just because of the niche quality of our business and the highly engineered components, we do have an amount of pricing power to offset any headwinds.
Okay, and then the two businesses I really love, obviously, like everybody, so it's not really that original. Anything levered to LNG exports and anything levered to the data center. I like the mosaic of businesses that you have. Would you ever double down on those, or would that get rid of the concept of having multiple businesses in different areas?
I would tell you that anything that is even modestly exposed to AI build-out has gotten extremely expensive. So I think that we'd be lean into our own product development there, and we've got a variety of different avenues to participate, whether it's the thermal connectors, whether it's the brazed plate heat exchangers. So we're all around the cooling units today, and I think that we've got a pretty good, robust IP plan around what we see how that market would develop over time. On the precursor components, it's a bit of an interesting market right now. We sell into the turbine manufacturers with internal parts. As you know, the backlogs are there. I mean, the volumes are significantly high. What we don't see yet is the midstream components that are going to deliver the gas to these turbines. And our expectation is in the back half of 2026, there's going to have to be significant spending in pipeline and distribution infrastructure to supply those turbines, and we've got a healthy position there.
Well, I know that's going to be an excellent business. I know that from the G. Vernova. We spoke to the CEO yesterday. That's exactly the sweet spot, and that's great news for us. Well, I want to thank Rich Tobin, Chairman, President, and CEO of Dover Corporation, one of the longest continuous dividend players, and a great mosaic that isn't tied to any particular industry. Rich, thank you for coming back on the show.
Thanks, Jim.
Mad Money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time for the lightning round. By the time I step first, the graphics is playing this out. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. I'm going to start with Leslie in California. Leslie.
Jim, the book is $14.95 and it goes straight to your Kindle. Buy, sell, or hold Novartis.
Oh, come on. Vass is a winner. He's absolutely a winner. By his Steelers, by the way, are starting to look really good. I'm a buyer of Novartis. Let's go to Charles in Maryland. Charles.
Yes, good afternoon. I wanted to inquire regarding IONQ and a quantum computer company that initially I thought was rather speculative, although Alphabet now has created a quantum chip.
Sure. So yes, they have. Now, look, this stock was at 84 10 days ago. It is now down all the way to 59. It was at 54. I think that it's going to get some money from the government. It's going to run up again, and then you're going to have to trim it again. It's a trading vehicle. I like investing situations. I need to go to Joe in Iowa. Joe.
Jim, howdy from the heartland.
Oh, man, good to have you. What's going on?
I was going to ask about QFIN 360 Holdings. I bought it back in July, and it had great numbers and was a skyrocket, and then the China trade stuff hit.
Well, the China financials, not for me. I like Alibaba. That's my only one over there. I'm sticking with that. Let's go to Phil in Georgia. Phil.
Jim, a big booyah from the 3rd Infantry Division of the United States Army in sunny Fort Stewart, Georgia.
Man, thank you for serving. Yeah, the 3rd. Wow. My dad was stationed down there for a while. What's going on? I'm sorry.
My honor and a privilege, sir. I turned a lot of my young soldiers onto you. Thank you for helping them become financially literate. I'm a member in the investing club, but I'll let you go. What do you think about KTOF?
No, I got to talk to you. I think that we got to bring you to New York. We got to meet you. You're terrific. We got to get here. I'm looking at my executive producer, Regina Gilligan. We're going to make this work. We're going to see you in New York. And then Kratos is a terrific stock. It's come down a bit. It's time to pull the trigger. And I got to tell you, it's an honor to speak with you. Thank you so much. Let's go to Luke in Arizona. Luke.
Hey, Jim. How are you? Thanks for taking my call.
Of course, Luke. What's happening?
Hey, I'm just calling about a little company called GSI Technologies.
Yeah, that thing is a rocket ship, man. I don't know. I got to find. What I'm going to have to do is I'm going to have to go. I may have to go right to Ben Stoto on this because they just did an equity offering, but it's straight up. And I think Stoto's going to know the answer because that's who Stoto is. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Tesla's shifting gears. From automaker to AI innovator, Cramer's tracking the evolution and what it means for your money. Next.
Tesla's not a car company. It's a technology company that, among other things, makes cars. That's why Tesla, the stock, rallied from $214 in the spring to almost $449 as of today. It's also why the stock ultimately rebounded today after it got clocked last night when it reported pretty light car sales and a big decline in profits. I don't blame anyone for thinking that Tesla was toast when its car sales didn't come through in China or Berlin or even here. After all, cars are still where the money comes from. It's why the stock opened down big, about 20 points. And that's where I said on Squawk on the Street that you had to buy it. Why did I think that? Simple, it's the narrative. You don't have to go too far in the conference call to realize what's really going on here. Listen to this from Elon Musk. Quote, we're at a critical inflection point for Tesla and our strategy going forward as we bring AI into the real world, end quote. He goes on to say, quote, no one can do what we do with real world AI, end quote. Musk says he has a pretty good insight into AI in general, and he thinks that Tesla's got the highest intelligence density of any AI out there. Who's going to disagree with him? Now, as someone who's dug deep into AI, I have to tell you that when I ask companies what they're doing in it, I often find myself suppressing a laugh because typically their answer is pretty much a dodge. The best you get is that they're talking with Sam Altman from OpenAI, a person who seems to talk to everyone. And then there's Musk. He's using AI to make the best full self-driving car. He's using it to dominate the robo-taxi game, or at least try. There's no doubt that he's got the best self-driving alternative on a price basis. He thinks there'll be relentless demand for the cybercab. When you read the conference call, he makes an incredibly compelling case to buy the stock of Tesla, but not because of cars. We've heard endlessly about how the hyperscalers are desperate for more energy. Musk has put AI to the task, and he recognized that if you could develop better and bigger and stronger batteries, that might be the answer for our energy-starved country. Storage may be the way to go. Listen to the way this man thinks. Quote, if you look at total U.S. energy capability, for example, there's roughly a terawatt of continuous power available in the U.S. The average usage over a 24-hour cycle is only half a terawatt because of the big difference between day and night usage. If you buffer the energy with batteries, you can effectively double the energy output in the United States just with batteries building no incremental power plants. Well, I got to tell you, the way the guy thinks, you know. The most exciting part of Musk's investable empire, though, is Optimus, the robot operation. There are so many obstacles to mass-producing robots that Musk says he's putting himself in the position of a startup to get it right. He says the only way he'll be able to produce millions of them is to think like that, which, of course, is what he wants to do. My favorite part of the whole conference call is when Musk talked about the difficulty of making the hand and forearm of a robot. As he put it, quote, it's an incredibly difficult thing. Especially, it's difficult to create a hand that's as dexterous and capable as the human hand. He says it takes real-world AI to figure out how to make a hand that can do things equal to humans and to do it at scale. Hate him or like him, man, this guy's real smart. Now, other than allegedly weak car sales, the most talked about part of the Tesla call was when Musk called proxy advisors Glass Lewis and ISS terrible recommenders for the upcoming proxy that he's got his contract request. He calls their musings corporate terrorism. I think that Musk, who says he needs to be in control so the robots don't take over, clearly wishes he had two classes of stock so he could be like Mark Zuckerberg, who can do whatever he wants with Meta. I say, even though he didn't start the company and therefore doesn't have the two classes, give the man the pay package he wants. Unlike so many other CEOs, he's actually worth it. Like I said, as always, bull market somewhere, problems I find just for you right here, man. Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.